Hi, this is James Eng with Old Capital, and this is Multifamily Underwriting 101. And today we're going to be covering four things. Number one, my background. Number two, how to underwrite a deal, whether you're a lender or investor. And number three, how to connect with Old Capital, and then also cover why multifamily investors use Old Capital. So let's just jump in right here. A little bit about my background. I was actually born and raised in Houston, Texas, went to school at University of Texas in Austin, and have lived in DFW since 2006. And I actually started my career at G Capital on the finance side, so corporate finance side. And in 2007, moved over to the real estate group here in Dallas, underwriting commercial properties anywhere from 25 million and up. So I did over $750 million in commercial properties as an underwriter. So that was office, industrial, retail, multifamily throughout Texas that I underwrote. And then since 2015, I've been a mortgage broker with Old Capital, really specializing in multifamily. So spent the last three and a half years as a loan originator on the multifamily side, doing about $500 million in multifamily loans, and also have been investing passively as an LP across 21 properties. Majority of them are here in DFW, but also a couple in Austin and San Antonio. So in total, closed about 1.2 billion in commercial real estate and investor in 6,000 units across Texas. And so today we're really going to be looking at, on the multifamily underwriting side, based on the input. So whether you have the address, the offering memorandum, the rent roll, the T12, and then also look up some comps, whether rent comps or sale comps, you're going to come up with a decision. And based on metrics such as debt service coverage, IRR, cash on cash, as an investor, we're going to look at, why you are either going to lend on a property or potentially invest in a property. So let's just jump right into it. So property address. So we're gonna go through these items at a high level. Then I'm gonna jump into the actual websites for some of these things. So as a lender, right when you first get a property, you're just gonna really Google it, and for a couple things. Number one, street view of the property, surrounding properties, and then potentially look at is there been any crime on the property. So it might be like the property name plus murder or recent crime or burglary, things like that on the property and surrounding neighborhood. And then also you're going to look at the street view and see if there's any gas stations or dry cleaners adjacent that might trigger any environmental issues. And then also look at the county website for tax information, sort of, how many parcels is this thing on? What's the tax rate? Who's the previous owner? Had there been any foreclosures on the property? How had they financed the deal in the past? And then also going on to the FEMA website to see if it is in a floodplain as a lender is important, because that's going to come up later on in the transaction. And then from the investor standpoint, one of the main things that I want to look at is what's your distance to freeways, retail such as grocery store, restaurant, employment, airport. Sort of your key employment drivers is going to drive apartment demand. And so also looking at demographics. And so median household income, median housing values, and then also I'm going to show you a New York Times census map, which shows income and demographics by census zip code, which I found pretty helpful and gives you an idea. So sometimes the 1 to 3 mile radius can be misleading. And this gives you sort of a block by block demographic look. And then really getting into projections on the submarket in terms of occupancy and rent growth, and then also drive-by traffic. So how much visibility does this property have, and what the potential is for you to spend on marketing for this property. Is it going to take a lot of marketing, or are you going to have enough drive-by traffic to really put the marketing budget at a lower number? So let's just go through a couple of these things. So starting with street view. So this is a property that's 100 units in Fort Worth that that we've financed before. So you can see, pitched roof, solar screens, majority brick exterior, asphalt parking lot, solar screens, and surrounding area. If you back up and sort of look at a satellite view, you have some retail along this street, and then also a bank across the street, and mostly single family surrounding it. And so I like the demographics of this particular area. Then you have a high school across the street as well. And so some of the other things that I'll be looking at, so we'll do a Google Street View, satellite view, and then we'll do a couple searches to see on Google, has there been any issues at that property? And so this particular property looks like, there hasn't been anything. These were some other properties, because this is a common property name. Other thing you want to check is your FEMA flood map. So this property is in zone X, which means that it does not require flood insurance. If you're in these areas, with the green or orange, that would be zone AE, and that would require a flood insurance. And then the next thing you want to check is also the previous history. So who's owned the property before, the age of the property, square footage, number of acres on the property, and then what is it assessed for. So when you go to underwrite the deal a little bit more in depth, you're going to look at the assessed value compared to your purchase price and adjust accordingly. And the last thing that I like looking at, this is all based on the address, is also the New York Times census map. This will give you an idea of the demographics of the area. So you can come in here and look at, income. You can look at demographic data such as housing. But this is a pretty good indicator sort of what the property surrounding area. So it's good to know sort of block by block how a property location is performing. And so let's move over. So after you look at the address, location of the property, you really want to look at the offering memorandum. So this is what the listing broker puts together. So this can be key stats, year built, number of units, parking spaces, unit mix is key here. So 1 to 2 to 3, what's the characteristics of the property in terms of roof, foundation, plumbing, any floor plans, pictures of the property, and then also pro forma. So the listing broker is going to put together a pro forma on the deal. This is usually the most aggressive pro forma that you'll see. Most buyers are, in between the lender and the broker's pro forma. So the investor, when I'm reading this, you really want to get an understanding of the story, right? So where's the upside potential in the deal? Is it interior upgrades, backyards, garages? And how much has the seller spent on the property already in terms of CapEx? And then also the comparable rents in the area. And so what they think is comparable rentals. So typical OM here, I'll pull up, we can start back here. It has just sort of your general property description and common area amenities, floor plans, location within the submarket, satellite view, some pictures, unit mix, and then also the pro forma. So this is always good to look at. So they're currently, in place, let's say is $800,000 in income, and they're thinking you can get it to $965,000. So that's usually the meat of the deal. Expenses down here, and then what you can get your NOI to. And so understanding that this is typically pro forma rents and pro forma expenses. So take it with a grain of salt. So that's the offering memorandum. So we've looked at the location, offering memorandum, and now let's jump over to the rent roll. And so we usually look at the rent roll right up front just to make sure that to qualify the deal as the lender, whether it's going to go Fannie or Freddie, needs to be 90% occupied for the last 90 days. I want to look at the unit mix of 1s and 2s and make sure that fits with the demographic in that submarket. And then on the rent roll, you can see, okay, you might be asking $850 for a 1-bedroom, but are you actually getting it? So InPlace versus market rent. Occupancy by floor plan is another thing. So making sure that there's no weird floor plans where it's difficult to lease. And then also tenant concentration. So you want to go sort of tenant by tenant on the rent roll and understand, is there an employer or military or student concentration on the rent roll? Because if it's more than 10%, that can impact your ability to get financing on the deal. And then, the investor is going to look at some of the same things, but more specifically, they're going to be looking at recent leases signed. So how much are they getting on the one bedrooms that they did upgrade? How much did of the rent is coming from the actual tenant versus percentage from housing? And then also, are they rubbing back any of the income for utilities and potentially taking lower security deposits? You want to make sure that the seller is taking a reasonable number of security deposits, and then also check move-in dates and move-out dates to make sure that they're signing long-term leases on deals versus short-term. So you really want 12-month leases on these properties. So let's go to the rent roll. This is a sample rent roll. So here you can see, tenant base, tenant name, rent, trash, rub backs for water, sewer, pest control, things like that. But then also at the bottom, you can see general occupancy at 96%. And then here you can see by floor plan. So, one bedrooms are at 97, and then 2 bedrooms at 95%. So it's pretty consistent across the board on this rent roll. And let's go to the next thing is that a lender and investor needs is the T12 or year-end financials. And so the lender is really going to be looking at a snapshot on the T12. So they're going to look at T3 net rental, T12 other income, T12 utilities, pro forma taxes, insurance, R&M, payroll, G&A. But the investor, they're going to be looking more for, all right, based on the historical net rental, has it been flat maybe for the last 12 months, 18 months? And what can I do to really increase that number? Because that's going to really drive the value. Are there any opportunities to rub back utilities, other income, and then potentially on the utilities, maybe even decrease them? So let's take a look at a T12 really quickly, sample T12 on this deal. And so on this deal, you can see here's a T12. The lender is really going to be focused on these last 3 months of rental income, and you, the investor, is going to look at the entire year to figure out, okay, how has this property performed, and how can I move the ball forward and increase the net rental? And so the lender is going to plug into something like this. And this is just a really simple Excel spreadsheet that we use to size loans. And so let's say you're looking for a $5.4 million loan, 330-year amortization, 5% interest rate, 104 units, 300 a door on the replacement reserve. So that is a debt service of $347,000. And so when you go to size the loan, you're going to do gross potential based on the rent roll. The vacancy is really solving for a net rental. So we saw in the previous that it was 3 months of net rental. So that was about $900,000 on an annual basis. And then other income of $100,000. So your effective income is about $1 million on this deal. You take your pro forma taxes, insurance, T12 utilities, your pro forma pro forma R&M, 3 to 4% management fee here, payroll, and then your G&A. So your total expenses on this deal is about $542, which is 56% expense ratio, which is, on a B minus C deal, you're really looking at 50 to 60%. And then your NOI is at 464 before reserves, after reserves 433. And so that leads to 125 debt service. So a lot of times people will come up and say, well, how come I'm not getting 80% leverage on the deal? And so let's say 80% leverage on this deal was $6 million. That increases your debt service to 386. And nothing really changed on the property, right? So this 433 is still the same 433 that was before, but your debt service is 112. And so you just cannot get a loan of that size. And so that comes into play a lot more than you think. So 5.4 million. But then another thing is on, let's say, Fannie Mae transactions, the interest rate can move on you. So let's say it goes up 5.20 because 10-year treasury moves up, then that drops your debt service to 122. And so your loan is going to have to come down slightly, let's say 5.2, to get to that 125. So a little bit lower, and let's say 5.3. So that might have cost you 25, that 20 basis point increase might cost you close to $100,000 in loan proceeds on this particular deal. And so next, so we looked at historical financials. Next, let's look at rent comps. And so rent comps, you really, the lender, they're going to be taking a snapshot of the in-place rents. They're going to be looking at actuals. But then if you go to the lender and ask for additional proceeds for the rehab, they want to see what your in-place rents are versus your pro forma rents. And also, if you're doing a bridge loan, they really want to see your pro forma rents because they are lending based on sort of a stabilized value in year 2 or year 3. Whereas the investor, they're really looking for the upside in rents compared to rent comps. So you really have to look at, okay, what are the rent comps in that 1 to 3 mile radius getting, but then how do they compare in terms of asset characteristics? So is it pitched roof? What's the ceiling height? What's the amenities? Does it have washer and dryer connections, individual HVAC? So for this particular deal, let's go to, we can pull typically reports such as Yardi, give us a breakdown of what's the in-place rents versus current. So on this particular property, here in yellow, it's highlighted. So they're 1 bedrooms, they're 650 square feet, and they're getting $728, which is $1.12. But in the submarket, in a 3 mile radius, people are getting up to $925 on deals. That is a larger unit size, but then something comparable unit size, maybe 675 is getting $820. So there's maybe close to $100 lift on the rent if you were able to compare this property to that property. So you want to drive that property, understand what what amenities that property has and how are they able to drive rent. And maybe those are upgraded units. And so maybe you need to put upgraded countertops, cabinets, flooring to get that rent. So understanding that piece. So that's on 1 bedroom, sort of going $728 to $820. And then let's go down to 2 bedrooms. So the average rent on the property now is about $875, which is $1.03. And there's another property about half mile away. It's getting $924. So, but that is a bigger unit size. And so understanding, what other properties in the market and how can you drive rents is important to the lender, but then also the investor, especially as they do their pro forma. Next, we want to look at sale comps, and the lender really is going to engage in appraisal and look at dollar per unit and see if it's in line with the subject. They're going to adjust for things like unit size, percentage of 1s versus 2, average square foot of the units, free and clear versus assumption, and then also the date of purchase. Investor, very similar. They're going to be looking at that to make sure that they're not overpaying for a property. So a lot of times we will pull a CoStar report. A lot of these deals are not in Texas. It's a non-disclosure state, so nobody has to show you what they're actually buying the property for. But brokers who sell a lot of deals in the market, they typically know what people are asking. They usually bid on the property to sell it, so they have a good idea of what it actually sells for. So in this 3 to 3 mile radius, in the past year and a half, 4 properties have sold, close to $62,000 a door at an 8% vacancy. So we'll really look at 1, 2, and 3 are pretty good comps. 4 is an inferior location. So let's take a look at these 3. Price per door is about $65, $73, $72 a door. These properties were built in a similar age to our subject property, similar unit count. But they were about a year and a half ago. And so the market definitely has improved since then. So you're probably looking at 75 to 80 a door for this particular property. So let's jump over back to the after you review the sale comps. On the underwriting, what we talked about from the lender's perspective, they're really going to be focused on in-place underwriting. So they're going to be looking at a 125 debt service, and then the investor, they're not only going to forecast year 1, but then how much can you increase the net rental from year 1 to year 2 to year 3 to really drive the value. So you have to forecast rent growth and then also residual cap. And so A lot of investors will use like a 5-year discounted cash flow. So they'll plug in, what my rent is today, what do I think I can get it to, and that sort of create their year one, and then also forecast, their expenses, and then come up with, all right, what is my cash on cash return? And then what is my total return on the deal? So on this particular deal, sort of plugging in the numbers, you're looking at about a 15% IRR on the deal, which is what most deals are going for in today's market. And so investors want, once they sort of plug in the numbers, then they're going to be looking at these metrics. So from the lender standpoint, you're looking at LTV and debt service of 125. But the investor, you're really looking at IRR, equity multiple, cash on cash on these deals to really decide, okay, do I move forward on this deal, right? So you need to make a decision. On the lender side, you're saying, do I loan on the property or not? So based on the LTV, debt service, does the deal make sense? And some of the intangible things like the borrower track record and the property management team and sort of where it is in the submarket are going to drive some of the other things like interest only, potentially more than 1 year of interest only, maybe 3 to 5 years, and then also interest rate. So you might be able to get better pricing for a better quality deal or a stronger sponsor. And then on the investor side, you need to decide, do I buy this property or not? And maybe you like the property, everything about it, but the price just isn't there. So the seller and you cannot come to terms. But at what price do I need a, let's say, $7.5 million price on this deal? So let's say 75 a door on this deal to make it work. And can I go out there and raise the money and hit, 13 or 14% IRR? Is that enough for my investors? And so deciding amount of rehab that you want to do, how much hard money you're comfortable, and then what type of loan to use as well. And so that sort of wraps up the underwriting piece. I want to share some points on Old Capital. So in 2018, we did $1 billion in multifamily loans. On the right-hand side, these are just 25 of the transactions that I did in 2018. Average deal size was about $5 million per transaction. So we're really looking at deals that are anywhere from 75 units up to about 300 units, all throughout the nation. And why people use us, you as an investor, you have a lot of things on your plate. You're out there searching out deals. You're out there trying to find equity. Our job is to find the best lender for your transaction. So whether that's a bridge lender, a Fannie Mae lender, Freddie Mac lender, local bank, we find the best loan terms for you. And then we save you time. So, when you, instead of going out and trying to get a deal under contract and then try to find a lender that can do your deal, we sort of already know the lenders in that market who can loan on that property, make sure that they can close. And if there are any changes, we have multiple lenders ready to go. And then number 4 is experienced team. So I used to be an underwriter. Many of the people on our team have had, 5, 10, 15 years experience underwriting deals. And so knowing what the bank needs, when they need it, and why they need it is key, because you will run into an issue on your deal. And knowing how to solve for that and knowing how to mitigate any risk for the lender is key. And number 5, inside information. So we do 1 out of every 3 B and C apartments here in DFW, but then also throughout the nation, we are, very, involved throughout, sort of your key markets throughout the nation. So get us involved early so we can help you win the deal. And if you haven't subscribed to our podcast, oldcapitalpodcast.com, we do an interview with lenders, owners, property management companies, one every week. And so that's a great way to stay involved in what's going on in Old Capital. And then also our Facebook page. So we spend a ton of time going out there, meeting with, doing inspections, going on property tours, and getting an idea of what's going on in the market. So it's a great place. And we do a lot of webinars there as well so that you can understand what's up-to-date information on today's market. And then next steps. So subscribe to the podcast, like our Facebook page, and then really to get started, complete the personal financial statement. And you can request that by sending me an email or giving me a call at the number below. and just start underwriting deals. So you have the skill set to start underwriting these new listings and start, getting a debt term sheet, put together your sponsorship group, and start making offers. And then, from there, close the deal. So thank you guys for joining today.